Welcome to the Master the NEC podcast, the ultimate destination for anyone passionate about the electrical trade. Whether you're a seasoned electrician, an eager apprentice, or just someone who wants to dive deep into the world of electrical work, you've come to the right place. Join your host, Paul Abernathy, a true authority in the industry with over 38 years of trade experience, as he electrifies your mind with in-depth discussions, expert tips, and valuable insights that will keep you ahead of the curve. Each episode, Paul will illuminate the complexities of the trade, decode the National Electrical Code, and share the latest industry trends, all while empowering you to take your electrical career to the next level. So, gear up, plug in, and get ready to supercharge your knowledge, because with the Master the NEC podcast, the power is in your hands. Now get ready. Here is your host, Paul Abernathy.
Hello. What up, everybody? Welcome to another episode of Master the NEC, the podcast where I, Paul Abernathy, talk about anything electrically related or electrical business related, industry news, all those type of things revolving around, obviously, the National Electrical Code and all things electrical. And on today's episode, I want to talk a little bit about we're in August now, and we have to start thinking about tax time. We have to start thinking as a business, if you're in business or you're contemplating getting into business for yourself and all those type of things. There's only two things that are guaranteed in life, and that is death and taxes. And while many of us, you can't do anything about death, it is what it is. You can eat well, but then you have somebody you know who died at 30, right? And they just appeared to be healthy as can be. So that we can't control. We can try, we can think we do, we can follow the quote science, but you really can't control that. We're just blessed for every day that we get. But taxes you can do something about. And the answer is not saying I'm not going to pay or trying to circumvent paying. The fact of the matter is you're going to pay taxes. And that's just how our economy works. This is not a democratic socialism. It never should be. You earn the money. It's your money. You use it as you deem fit, but you're going to pay your fair share. And for everybody that says millionaires and billionaires don't pay their fair share, they don't understand that they run companies and businesses and they pay a lot more taxes. It's not just about income tax. There's payroll taxes. There's other taxes. So again, I don't want to get into that. You know, the people that go all the way to extremes want to talk about that. But that's not what we're going to talk about today. I'm focused on business. I'm focused on your electrical business. And there's a guy, I'll say this right now before I get into the talking about taxes. There's a guy on TikTok. He's the real tax guy. That is his actual username. If you go on TikTok, he's called the Real Tax Guy. And this guy gives very solid tax advice. In fact, the same type of, now my business structure is very different, whereas most of the stuff won't benefit the Electrical Code Academy because I have very little going out and more coming in than going out, other than marketing stuff and normal business expenses that would just be normal, but not invoices and all this kind of stuff that you may experience in your contracting business. So a lot of the things he'll talk about is not really directed specifically to me, but it does bring back the fact that I was an electrical contractor for many years in multiple states and how I did my business. And you might be thinking about that. And it's I always tell people when I'm in the summer, I'm thinking about how I'm going to sustain myself in the winter. And in the winter, I'm gearing up for making that money in the summer, fall, and spring. So obviously, taxes have to come into that equation. Now, before we get started talking about taxes, I want to make it very clear. I am not a tax expert. I am not a CPA. I am not an accountant. I am not somebody that you take 100% tax advice. What I'm providing you is information that I've learned along my journey. But again, you do your own due diligence. Again, disclaimer, I am not a tax guy. I'm not giving tax advice. I'm not giving legal advice. All of that up front. Now, if you want to stop listening at that point, that's your prerogative. But I'm going to talk about business and things that just kind of make you think about business when it comes to taxes and preparing, because you need to prepare early. And your whole year, you need to be understanding the structure so that you don't get hit by any surprises at the end of the year. Okay. So, for example, I am a Chapter S corporation. Not a C, a Chapter S. It all passes through to me personally and a K1. But I do get the benefits of business expenses and things like that are for the business, not for me, for the business. So, differs from an LLC. Again, I'm not a lawyer. I'm not telling you how to structure your business, but an LLC is more so for risk. It's not really for anything else. You're going to have to, it basically operates just like a sole proprietorship, but it does separate you from the business. So if you're making $1 million a year or more, or your businesses have substantial amount of income coming in, then you need to talk to somebody that can show you how to structure that and possibly reduce your personal risk. Okay. But that's kind of what these different categories do. There were many reasons why I chose Chapter S, and this isn't my first Chapter S. I've had a Chapter S all the way back when I had K9 Grooming Incorporated and Electrical Service Specialists and all that, which was my contracting businesses, and I own boarding kennels, things like that. And so, and grooming salons for pets and things like so. I've always had some kind of structure to my business. Okay. So just, make the right decisions. It's okay to start off as a sole proprietor. And just remember that if your business doesn't have a lot of assets, then it really doesn't matter. But as your business starts growing and get assets, and you might want to think about the risk involved. And of course, and that's the case there, then you're going to, need to talk to somebody and see what's your best move. Okay. All right. So today I want to kind of talk about taxes in general from contractors' perspective. And we're going to be addressing things like federal taxes, state rules, and obviously I'm going to talk contractor business structure, all part of this overreaching conversation. And again, not giving tax advice, but kind of telling you how to think about things. And, I'll just start off right away into the one that I hear all the time. And that is a write-off does not make something free. So I hear this a lot where people say, well, I'm just going to go buy it because it's a write-off. I always tell people, first, you got to have money in your account to do this. Okay. But it's not a 100% write-off. For example, if I'm spending $10,000 solely to get a deduction, that does not save me $10,000 in taxes. Okay. That's probably one of the biggest misconceptions that people out there, and I'm sure the real tax guy will make it clear to people if you reach him out, and he'll do 3 years of your taxes. He'll look it over for free. So if you're in business and you're starting out, man, take advantage of this guy's offer over on TikTok. He's called The Real Tax Guy, and he's legit. Okay, so if I'm thinking in my business, and people always do this, you're getting, and I've done this, you're getting towards the end of the year, or you're in mid-year and you're thinking, okay, I'm making money. I need to get these write-offs. Okay. So you spend $10,000 and you're thinking that you're going to get $10,000 and you're going to save paying $10,000 in taxes. So at the estimated combined tax rate of, say, 30%, combined state, federal, whatnot, it might save approximately $3,000, but the business still had to spend the other $7,000. So you're not getting 100%. And that's what a lot of people seem to think, right? Is that I'm going to get 100% back off my taxes. That's just not how it works. Remember now, never buy a truck, tools, or a piece of equipment merely because someone says you can write it off. Okay? And that's the easiest. That's probably the number one thing I hear people say, well, I get it. Now, if you need something and you need it anyway, that's great. I mean, you're going to get something off because you can deduct it. But it's not 100%. So I'm like, I hear people that say that all the time. Well, just go this, you can write it off. Yeah, well, it doesn't make sense to spend $10,000 only to write off $3,000. You get what I'm saying? So that's the first thing I remind you. Now, again, if you need it, you need it. And it doesn't really matter. The write-off is a bonus. Okay. And that's the way I always think about it. So I never go in and say, God, I'm going to buy this because I'm going to write it off. No, because everybody thinks, well, not everybody. A lot of people think that if I spend $10,000, I can write $10,000 off my taxes. Well, that might be what you write on the form, but in your combined tax rate, that is not what's going to happen. You're not writing off $10,000. Okay. So that's a first one that I guess that is a biggie, because that is something, and I'm sure that Real Tax Guy hears all the time, and other people hear that all the time. So now, number two, I guess it would be the expense must be ordinary, necessary, and genuine business related. So the IRS generally requires a deducted expense to be both, number one, it needs to be ordinary. And what that means is it's common and accepted in the electrical contracting business, if you're an electrical contractor, okay? So, you could go buy something and it would be ordinary. Let me give you an example. I bought an excavator and, and I'm in the electrical education business and training courses and whatnot. I did not write off that excavator. Now, some people say, yeah, but you're still electrical. You could have done some work. But, the vast majority of the work I do with it is around my house. It's my toy. But there are folks out there who are under the misconception is, oh, I need it for something else. Let me just buy it and write it off. If it's not ordinary, common, and accepted in whatever your business structure is, then you're throwing up a red flag. And so I don't do it. I just bought it and pay my taxes on it. And it's just, or just buy it from personal expenses. It is what it is. I'm not going to try to write it off as a business expense. Now, I'm sure people want to argue and say there's blurred lines, but those people obviously have never been audited and they don't have to explain that to somebody. They just did it. And that's their prerogative, but it's important to distinguish the fact that the IRS looks at it. And again, I'm not an IRS expert. I am not a tax expert. But if you ask your tax experts, they're going to tell you that to write it off, it must be ordinary, necessary, and genuinely business related. Now, the first one was ordinary. The next one's necessary. If it's helpful and appropriate for operating the business, then there you go. It is a legitimate something that you can put down as an expense. Now, personal and family expenses do not become deductible merely because they were paid from the business account. That's called mixed use items, such as cell phone, internet service, vehicle, and computers, must generally be divided between business and personal use. Okay, so that's the one where people want to get it confused and where it needs to be. And my simple example for my cell phone system, business is the fact that for me, I pay my cell phone visible 1 year, one fee. And so it's one time, and well over 95% of its use is for business use. It's the number I list on my websites. It's the number I list. So it is widely used as my business. Now, can I make a personal call with it? Absolutely. But the fact of the matter is, the vast majority, overwhelming majority, is for business. My internet service here is for my academy. It allows me to maintain my websites. It allows me to do this constantly. I have a NAS system. It's constantly connected to the internet. Everything I back up on it. So again, now vehicles, I don't write any of it off. Computers, I don't write any of that off. Even though these computers are used for business, they were paid for a long time ago. There's no, anything. Now, if I bought a new computer and it was for the business, then that will be a different story. But trying to write off personal things simply because you use it as part of your business can create a mixed use situation where you're going to have to explain it. Okay. And again, there's IRS documents for that. You can ask the Real Tax Guy, but there's lines in there that get drawn. And again, I'm not a tax expert. And as long as you can explain it or justify it and be able to document it and things like that, to me, it would be very hard for them to tell you that you're using your internet service for personal when you're like, no, I'm really not. I'm only really using the internet when I'm working on it, and you really can't segment it out. Or if you say, look, I live rural. My cell phone service is purely business. Now, somebody might call me, but most of my interaction is business. So these are things that you need to document. These are things that you need to justify. But again, if I worked in a business and somebody called me on a personal nature, that doesn't immediately mean that it's not business. It's just somebody called that number, right? So again, there are lines there, but if it's majority, used for business activities, again, that's something you'd have to talk to your tax guy, that type of thing. But in my case, a cell phone is like, what, $400 a year? And that's it, unlimited. So, is what it is. The next thing we would think about is keep business. And this is something I tell my son, I tell other people as well. And this is something that I did early on in my academy is keep business and personal money separate. So every contractor should have a dedicated business checking account and preferably a dedicated business credit card. Okay. Now, save receipts, invoices, canceled checks, customer payment records, loan documents, payroll records, proof of business purposes for each expense. The IRS says that books must be clearly show income, deductions, and credit, and the supporting documents must substantiate the entries. Now, for me, I use QuickBooks Online, and I tie everything to my business credit card, and I pay all credit cards off every month. I never have a reoccurring balance. Dave Ramsey, he hates credit cards because he understands that the vast majority of people don't know how to manage a credit card. When you're putting large expenses on a credit card and you don't have the ability to pay it off each month, then this can be reoccurring, and that's just throwing money down the drain. So the first thing I tell business owners is if you get a business credit card, preferably one that earns you points, things like that, that you pay it off every month. You use that as your credit line, but you have to be prepared to pay it off. Do not continue it. Now, as far as receipts and everything, I don't keep receipts on those purchases, and I'm probably doing wrong. So again, don't listen to me, but all of my stuff is tied to the credit card, and the credit card puts it straight into my QuickBooks Online, which I have payroll as well. Now, I pay $100 a month for that peace of mind. I'm telling you, folks. And I'm not here stomping QuickBooks Pro, but it was the best decision I ever made because for years I did my own payrolls. I had to worry about all that. I had a CPA that helped take care of. Dude, the moment that I switched to QuickBooks Online and their payroll system, even the basic payroll model that they take out the taxes, they pay the taxes, they pay the state, it made my life so much easier because you know what? I'm an electrician. I ain't into that shit. I'm not. I don't like the books. I don't like that part of the business. So for me, was it worth $1,200 a year to have something keep track of all my expenses? Because everything gets put in the right category. Then when I do taxes, I just go through and I make sure that in the category, and I take notes to the year on this meeting, that meeting, this expense, but usually everything is covered in the invoice. In the receipt, right? But if you do invoices and things like that, if you have loan documents and all that, and my payroll records are always automatically done by QuickBooks Online. I have that payroll service. Okay, it does it all automatically, so it keeps track of that. But the general rule from the IRS is many tax records should be retained for at least 3 years, employment tax records for at least 4 years, and property records until after the property is sold and the applicable limitation period expires. Well, again, I have tax records going back 15 years. I could get rid of them, but I'm paranoid. I just keep them because it's just paper, right? I just keep them in a filing cabinet. But you don't have to. My employment tax records are all kept online, and I print that off as a report every year. So I keep those records, right? And you got to get used to that. So I know so many people that are young, that are starting in business, and they hate keeping records. They hate it. But the first thing any new business or electrical contractor, or anybody that's starting out, like I said, the first thing you should do is get your business license, get insurances if necessary for what you do, okay? And have all the adequate licenses that are required for whatever you may be doing. Make sure you got all that ducks in a row. And then make sure that you get a separate business checking account or account that can separate. It doesn't necessarily have to be a business checking. It could be another, like a personal account, but it's only used for business. A lot of times they want to force you into a business account when all you're trying to do is just separate the finances. So on the surface, whether it's personal banking or business banking, it really doesn't matter if you're only using it for business. Again, not a tax guy, not giving you tax advice. I'm just saying it makes sense to me, okay? It just keeping things separate. Start out right up front. keep records up front. Just make your life so much easier. And I know you hate it. We hate doing taxes. We hate keeping track of things. We hate it. But it is part of the business. It's part of doing it legitimately, doing it as business. You get me? Okay. The next thing that I hear a lot from a contractor starting out, because they're putting a lot of road miles in, is they track every legitimate business mile. So electrical contractors, you're always on the go. And you can accumulate substantial mileage between going to the supply houses, job sites, inspections, estimates, service calls, various meetings, whatever. You're putting a lot of miles on vehicles. Now, without a contemporaneous mileage log, a potentially valuable deduction may be difficult to defend. And so in my situation, and I'll just tell you what, and my son's going through this, I can tell you in my situation, I have an app on my phone called Driver Notes. It's Drivers with an S, Note. And it tracks, and I use that diligently to put in anytime I go anywhere for business, and it keeps track of it, okay? If you're just going to write your mileage down, then you better take copious notes of where you went, why you did it, what you did. You can't just write off every single mile. Even if it's for personal use, it's not business use, you can't write that mileage off. I know it's tempting to want to do that, right? But it's you got to be legit here. We're not trying, I think one of the biggest things that I can tell a new contractor or somebody getting into it is don't try to screw the IRS. Don't try to screw the government. They're going to get there anyway. So you just create potential hazards and problems for you that can follow you down the road. It's just not worth it to gain a little bit and take that kind of risk, okay? It's just not. So document everything. So for 2026, the federal business mileage rate is 72.5 cents per mile from January 1st to June 30th. Then from July 1st to December 31st, it has jumped all the way up to 76 cents per mile. Serious. But this is legit business. I had somebody call me and say, Paul, I have a certain amount of mileage. I have 100,000 miles so far this year. And I'm like, there is no possible way that you could work every day, be productive, make money, be on a project, and have 100,000 miles. It's just impossible. It's not. No, it's not. It is. Do the math. If you're working 8 hours and you're on a project and maybe you're going from one project to another, but to me, it would be just unfathomable for you to have 100,000 miles. But nonetheless, if you had 100,000 miles, there you go. Okay. 72.5 cents per mile for the first part of the year this year, and then 76 cents per mile for the second part of the year. Now, the mid-year increase means contractors need to separate the first half from the second half. And you got to remember that when you're doing taxes, okay? When you're putting in your mileage and you're putting it as a deduction, remember that there's a first half and there's a second half, okay? Keep that in mind. But what you need to do, and that's why I like to use this app, and it's a free app on the app. I think it's on Google Play Store. Again, Driver's Note. You should give it to all of your technicians. You should give it to all of your employees. Again, and you can even have it track you GPS, so it automatically does it. So it's pretty cool. And as a business, you want to take advantage of this, right? It's a legit deduction. And it can add up, dude. 76 cents a mile if you're on the road all the time. But now, one of the key things you need to you can't just write the mileage down. And I think that's one thing that I think that if it gets questioned, especially if you have some gross amount of mileage you're trying to write off, the IRS is going to look at that and go, wait a minute. Did you record the date, the destination? What was the purpose, the business purpose of the miles driven? Do not treat ordinary personal commuting as business mileage. Okay? I think that's a problem where people are going to get into with this and think that anytime I'm in the car, that is a business that I can deduct the mileage. That is not correct. And again, I'm not a tax guy, but I need to remind you something. If you are doing the mileage deduction at 76 per mile, then you can't charge for things like the gas monthly, submit your credit card or whatever it is for gas. It's either this or that, okay? Whichever one yields the bigger deduction, you go with. But again, the normal wear and tear and all that kind of stuff, mileage on the tires, all that stuff is covered in that mileage that you're trying to deduct, okay? So you can't double dip. But I'm not a tax guy. I'm just telling you, talk to your tax person, they may have ways around that or understand it better than I do. I'm just saying that double dipping in things like that is a no-no, okay? No-no. Next thing for all of you electrical contractors, I guess you don't have to be an electrical contractor to listen to this and understand it, but these are things that you need to do up front to make sure that you're running your business properly. Okay, so if you're coming into this late, go back to the beginning of this podcast and listen, because these are things that are going to help your business. You want your business to grow, right? You may be shoestringing it right now, but you want it to grow, right? So you want to make sure that you set your foundation of business up properly, do the right things, the right licenses, the right insurance, or everything that you need to do this right up front. Get used to some kind. For me, like I said, I got a business credit card and everything goes on that's business related. And I've got a personal credit card. That way I can separate the two and it makes life so much easier. Now you might say, oh, I can't qualify for a business credit card right up front. That's fine. Every business starts up that way. Probably can't get a business credit card. But if you get a bank account or a business account or a personal account, usually they have a debit card. And you use that debit card to make those purchases so that it keeps track and it keeps it in that separate account. Now, let's face it. You say, well, I don't have the money. Yeah, then you don't probably need to be in business. If you don't have enough money to seed your business and be able to sustain you for a certain number of months, depending on what industry you're in, then that's a problem because you're going to intermix your personal and business together, and it's going to be hard to separate that when it comes tax time, okay? So if you have a personal account, but you need to seed the business account, then you transfer money and you notate it and you make it clear that you're transferring money over to the other account, which is the business account, and then you make your purchase, okay? And then you document between it. Again, tax guys will tell you, the right way. I'm just saying you need to make sure that you document it. I just don't like reaching into the kitty, which is your personal, to pay business, and now you have to explain it. If I move the money I need over to a primary business account, then it's easy for me to show the reason I made the transfer from personal to business. And then that money's owed you because you're loaning money to the business. Okay. And again, that's why it's so important to talk to a tax guy like the Real Tax Guy on TikTok and bring up these things so that you can do it right from the beginning. Because again, I'm not a tax guy. I don't claim to be. You don't listen to my advice 100%. Do your own due diligence. I'm just trying to help you get off on the right foot as an electrical contractor. That's all I'm doing. Next would be categorize job costs and overhead correctly. Do not dump every purchase into a general category called supplies. Now, this is one that even I struggled with as a contractor, thinking I just do one big lump and that would be it. That doesn't work. You need to figure out what your expense categories are. And a contractor should separate and identify expenses such as, think about it this way. You should have a category for your job materials and direct product costs. So in other words, what you're buying and using for a project. You should have a separate category for tools, small tools, consumables, personal protective equipment like PPE, anything that's separate. Okay? Because that's used broadly on multiple jobs, not just on one job. Next, you should have equipment rentals. So if you're renting equipment from anybody, anything, you would put it in that equipment rental. You may or may not have that category. Again, all these categories may not be applicable to you, but you need to think about how you structure these and how you put these things into different categories. Permit and inspection fees, separate category. Subcontractor charges. So if you hire subcontractors, the payments that go to them, you make sure that you have those expenses in a separate subcontractor category. You don't have that intermingled with the other jobs that you may be doing. That's fine. But if anything you're paying out to a subcontractor, make sure it's in a category by itself for easy tracking. Licensing and continuing education. If your trade or whatever you're doing has continuing education and licensing requirements, all fees and things that you pay associated with that education and licensing, that gets dumped in that category, right? And of course, you can always subdivide these categories. You could create a category licensing continuing education, and inside of that, you can have a licensing category and a continuing education category. Remember, I use QuickBooks Online, which also I have the QuickBooks Payroll. So everything that I do is put in categories. And they may not be the best accurate categories at the time, but over time I've developed what mine are, and I tweak that at the end of the year until I get it exactly the way I want it. And then year after year, it's just rinse and repeat. Doesn't mean you can't create another category, right? So, I mean, I'm a big believer in the QuickBooks products. I just like the online one because I think it's being backed up and it's being stored, and I'm just, I got nothing to hide. So, it's not like, oh, I don't want the big brother to see what I got. I don't give a shit. I'm very transparent. So I don't worry about that. The next category would be any liability, vehicle, and workers' compensation insurance. Remember, again, I'm not a tax guy or a legal expert, but I will tell you that in most states, like Virginia, until you have 2 or more employees, you don't have to have workers' comp for yourself or even somebody that helps you. Typically, you don't need workers' comp. However, it's important to think about it because somebody gets hurt. Then, you know what? If you're just a sole proprietor, you're at risk. That's it. That's why people go into an LLC and other things to separate that risk, not just financial risk, but personal risk. Okay. But at the end of the day, there are projects that you may do that they don't care how many employees you have. The fact of the matter is they want to make sure that you have workers' compensation insurance. Okay. Well, it's easy to get. You can go online, get it, and pay it month to month. There's Next Insurance. There's other ones out there that you can get it and you can cancel it if you don't need it. If you're a mom and pop, you're a one-man show, 2-man show, 1-woman show, whatever. But as you grow, obviously you're going to need liability insurance, workers' compensation insurance, and whatnot. Vehicle insurance if you have a company vehicle. Next category would be advertising, estimating software, and accounting subscriptions like what I do, QuickBooks Online. I used to use QuickBooks Pro, which was physically on my computer. And every year I would print that down into a zip file and I would take it to my CPA. Okay. So everything now is online. So it just makes life so much easier, right? That type of thing. And of course, office, telephone, and internet expenses, again, separate category. Again, you can subdivide categories. That's fine. But correct categorization helps determine actual job profitability and whether an item is currently deductible or included in the job cost or treated as a capital asset. So at the end of the day, it just makes life easier. And it also, if you do have a tax person, like the real tax guy on TikTok, for example, it makes their job a little easier. And obviously, if they don't have to work as hard, the cost is not going to be nearly as high. But if you do like some people I know, just take it and dump a freaking a box full of documents on the desk of a CPA or a tax person, they're going to be like, oh crap, you're going to pay for my time, right? So again, these are little steps that ultimately do save you money because their time is valuable as well. And they get paid good for their time as they should be. Okay. All right. Now, again, so think about that. Set it up early. Don't let it get so far down the road in your business that you scramble. One of the big problems I had early in business was I just threw everything in a box and said, I'll handle it at the end of the year. And that's fine when I had very little expenses, small stuff, I hear people say this stuff all the time is pay yourself before you pay other people. And that's bullshit. I don't care if you understand it or not. That is not good advice. I hear CPAs say that. I see other people say that. I say, pay yourself before you pay others. That's bullshit. As a contractor, you need to keep your vendors happy. You pay your staff. You pay bills that you have. You're the one, as a business owner, you're the last one that gets paid. Seriously. And if after everything is paid, there's nothing to pay you, then you can't pay your bills, then you need to reevaluate your business. And that doesn't mean expand your business. That doesn't mean it at all. That means there's something wrong. You have a budgeting problem. And you need to analyze because you've got more going out than you got coming in. And that's not a good outcome for any business, right? So it just means that you need to reevaluate. Okay, now, under depreciation before buying expensive equipment. Now, let's think of it this way. And again, I'm not a tax guy, but I have made some large purchases in my different time, and I've made a decision not to include it in my taxes for business because I knew that the vast majority of it would be used for personal use, right? So, I had to think about those and make these important decisions on whether or not something was going to be a tax write-off or try to tax write-off a portion of it. Now, a large purchase such as, let's say, service trucks or a trencher, or in my case, a mini excavator. Now, if I was an electrical contractor, I could get away with the excavator because I'd use it to dig trenches and things like that. I'd get away with it, but not as an educator. I'm not going to get away with it, right? But generators, cable pullers, testing equipment, all this kind of stuff, tools, may not automatically be treated the same as an ordinary supply expense. So for the tax years beginning in 2026, a general Section 179 limit is $2,560,000. With that deduction being to phase out when qualified property placed in service exceeds $4,900,000. So special limitations apply to certain vehicles, including a $32,000 Section 179 limit for a qualifying SUV. So there's certain rules that you have to understand, and this is where it's important before you make a big purchase that you do reach out to tax people that understand these rules, right? I'm going to give you an example, and this is just me. I don't listen to a financial advisor that hasn't listened to their own advice and they're not loaded. Does that sound stupid? I get it. I'm going to have people out there send me nasty messages and says, well, I'm a good financial advisor, but if you're good, then you listen to your own advice and you're making money. But if you got no money, so one of my questions I always ask, any of those financial advisors is, what is your net worth? What are you worth? If they don't want to tell me, I don't want them to be my financial advisor. That's just me. I'm not telling everybody. I'm just saying me. So when it comes to taxes, that's why I reach out to somebody if I have a specific tax question. And that's why I think that guy on TikTok is so great. And tell you the truth, it is unrealized by many people out there that this guy is giving this kind of advice because he's been doing this 30, 40 years. And he's even offered to do your taxes and look at your taxes for up to 3 years in the past. That's freaking amazing. I'd love to have him on the show, do a podcast with him. But he's an amazing guy. And he's the kind of guy you're going to ask those questions before you go out and make that major purchase, okay? Especially if you're going to do it depreciation and use Section 179. So current law also generally provides permanent 100% bonus depreciation for qualified property acquired and placed in service after January 19th, 2025. Eligibility, vehicle limitations, business use requirements, again, not personal use for business use, and potential depreciation recapture still matter. And again, you need to talk to a tax professional, not after you buy the equipment, not after you sign for the equipment, but prior. So just stop and think. You've got a guy right here on TikTok who you can ask him, you can contact him and maybe pay, he should be, I'm assuming he charges a consultation fee to give you advice based on your situation. So many people have so much pride that they don't. I do not. Dude, I do not. I want to see electrical contractors succeed. I have no problem asking people that are knowledgeable, but you have to qualify these people. It's like I tell you about the National Electrical Code. Listening to people on TikTok and Instagram and Facebook, they're not qualified people. They may have gotten their license and they think they know something. They talk a bunch of smack. But the reality is, I prefer to talk to people that if it was code that I talked to, my friends of mine, like Mike Holt, the Phil Simmonses, Ryan Jacksons, the Vince Delacroces, the people that have been in the trenches and I can verify they know what they're talking about. Not some guy who just got his license and said, damn, all these educators are making money. Let me just go start up a YouTube channel and now I'll start making some of that money teaching people how to pass an exam. Because they just passed an exam. But they've never done anything else. They've never served on a committee. They've never written any books. They haven't written any articles that can shed light on what their knowledge is. They haven't done anything. But you're going to listen to them? You're going to give them money? Well, that's up to you. I can't tell you what to do. But I'm going to listen to the tax people that know what they're doing. Okay? So, there you go. That's the best I can give you with that. All right, the next thing is meals. And I just recently was actually doing a back and forth, in TikTok with the Real Tax Guy. And I don't think he's replied to my last question I did yet because he's probably very busy. But a lot of people think meals are 100% deductible. Now, over COVID, I believe there was a period where it was, but that's no longer the case. So most qualifying business meals, and I'd say qualifying, we'll talk about that in a second, remain limited to 50%. Well, you still get to eat the meal. You still get the meal. And then having any type of write-off in a legitimate business meal is worth it. It's a lot better than not being able to write it off at all, right? So I'm not crying about a 50% write-off on a legitimate qualifying business meal. So the contractor or an employee generally must be present. The meal must have a legitimate business connection, and the expense cannot be lavish or extravagant. So, it says the contractor or employee generally must be present. Nothing says I have to have 15 people, 10 people, 2 people, even 1 person. If the meal is legitimately part of the business and it's connected with the business, I'm out working hard and I'm the CEO of my company and I work hours in the night and the day. If I want to have a legitimate meal that benefits my business because it keeps me sharp, ready, it keeps me focused, then by damn it, I should be able to write that off. But so many people on the internet said, no, that would be a personal meal. If you own the business, there's legitimate reasons. Now, a lot of people say that, you got to go a certain mileage away from your business area in order for it to be qualified. That's bullshit. That's not true. Do you think the IRS cares where you have that meal? They don't give a damn about where you have that meal, but it has to be a legitimate business connection. For example, I have a lot of meetings with my brother in my business. And because he's an active electrical contractor that's actually out in the field working, and I've created a lot of products on StackCaddy based on his experience. So I am constantly picking his brain about, do I need to create this product, that product? I created the insert based on his feedback, and we had meetings on that. That's legitimate business. Oh, but he's related to you. You can't do it. Where does it say that in the tax code? I'm not a tax expert, but it's legitimate business expenses. I have a lot of meals that I do not write off because they're not legitimate business use, but ones that I do are legitimate. Another example is I might write off a meal on a rare occasion where I'm out somewhere with my wife having a meal. And you say, whoa, that's your wife. That's personal. You can't write that off. No, I document it. That meal is for me to run a lot of things. We just happen to be out, and I will run a lot of things by her from a consumer because I sell products to consumers for StackCaddy and other things. And I want to get her perspective because my perspective is always going to be skewed, right? And sometimes I want another opinion, and my wife is not afraid to give me her honest opinion, whether it's not just always agrees with me. But she understands it because she's been around the electrical industry for 40 years. She's been there in the conversations. She's been there and when I've been teaching. She's been there at seminars. So she understands how the customer can react or how the individuals, or when I'm creating a course or I'm creating a separate type of product that I'm trying to get a broader range of consumer, in Stack Caddy or something like that. She's a launching pad, if you will. But it's got to be legit. It's not just, hey, baby, let's go out and have a meal and we'll write it off. But that's what you have to determine. So I don't do it all the time, very rarely. But to be fair, my expenses, food expenses, are very meager, right? I maybe have $1,500. So it's I may have $1,500 or $2,000 worth of meal expenses in a year. So again, 50% of that is not a big deal. It's not a big deduction, but it's still a deduction. But if you're a contractor, you're out there, every interaction that you have during the day is typically going to be business related. You start at 7 a.m., you end at 5. And if you're your own employer, you're working 5, 6, 7, 8 o'clock at night. If you want to have a meal by yourself because you're busy working, then you are the lifeblood of your business. You are legitimately the connection to your business. If I stop and eat and I want the company to buy that meal, I will do that every day of the week. And you know what? IRS, let's see where the chips fall. Because to me, I am the business. If you're the contractor and you're the one-man, two-man show, or you're the business. Everything you do during your work period benefits the business. That doesn't mean that I go out at 9 and 10 o'clock at night just to have a meal. I have a hard time justifying that. But if I'm out during a work day, legitimate work hours, published work hours, then why can't I treat myself? I'm the owner. I need that nourishment. So again, I have a hard time telling people, that when, it's not lavish or extravagant, it's a damn Wendy's, it's a damn McDonald's, it's a damn Burger King. It's because I am the business. But again, I'm not a tax guy. Somebody will say, oh no, you can't write that off, because you're by yourself. You're not me. But what if I'm taking calls during that business lunch? Because a contractor never stops working. I might be sitting there at lunch and I might be working up an estimate. I still got to eat. So your situation may be different. Okay. So remember, entertainment expenses are generally non-deductible. Even when a customer or a potential customer attends it, keep the food and beverage charges separately stated. Whether meals are purchased at an entertainment venue, again, keep them separate. Meals and beverage, keep that separate from any other entertainment expenses, because entertainment expenses itself is non-deductible mostly. Again, talk to your tax guy. But when the food and beverage part is, okay? So what you should do is write the attendees, if there is any, the business purpose, what you did on a receipt, or record it electronically. For me, it's a restaurant meal. I'm only going to use, so I make it simple. I only use my business card for a meal that I am going to justify it's a legitimate business meal. That's it. That's it. All right. And again, I'm not a tax guy, so you can talk to your taxer. You can disagree with me in the comments all you want. You can say nasty shit like you usually do. That's fine. I'm just giving you my perspective. Again, I'm not a tax guy. I'm not giving you tax advice. I'm not a CPA. I'm not an accountant. I'm not a lawyer. I'm just an electrician who started electrical contractors businesses years ago and been running them for years and do education. I'm just trying to get you off on the right foot. Okay. The next one, a legitimate home office may qualify. I do not use my home office as a tax benefit. I do not, because I don't want that to be a gray area, because it is limited, and I'll explain the limitations with that, but I just don't write off anything to do with that. So, but you may, if you're legitimately working your contracting business out of a room in your house, and it's legitimately where you do your estimating, your bidding, all your business stuff, it may benefit you. So many electrical contractors perform estimating, billing, scheduling, purchasing, payroll, and permit work from their home. Okay? You work from your home. It's perfectly fine, because your truck is your work site. Okay? So a home office may qualify when it is used regularly and exclusively for business. For example, I do have this area in my house that I don't do anything here but business. This is it. This room, nothing but business. Okay? I could probably write that off as a home office. I just choose not to do that. And so to me, it's a red flag, but again, it's legit, but I just prefer not to do it, but you may. So a home can also qualify as a principal place of business when the contractor performs administrative and managerial activities there and has no other fixed location where substantial administrative work could be conducted. So I do everything. You may do everything in your house. That's legit. That's a home office. So the simplified method is generally $5 per square foot up to 300 square feet, while the regular method allocates qualifying expenses such as utilities, insurance, repairs, rent, mortgage interest, and depreciation. Okay, so that's the regular method. But the simplified method is just $5 per square foot. That's it, a month. But again, talk to your tax people if you want to do that. If you're doing all of that out of your home and you're doing everything out of a room in your home and all you do in that room is your business related, then dude, you should be taking advantage at least of this. Okay. Now, a kitchen table used by the family normally does not satisfy as an exclusive use requirement. Remember that. We're not talking about just because you go into the dining room and you do all this work in the dining room. That is not what we're talking about. I have a dedicated room. It could have been a bedroom. Your kids go off to school, they go off and leave home. You now take that bedroom and you convert it into your office. That is your office. That's what you go in there to do business. Bidding, estimating, planning, whatever. Then, dude, you're legit. Take advantage of it. Contact your tax person. See what they say. Ask the real tax guy on TikTok. See what he says. And if you're worried about an audit because of that, then really shouldn't be that hard to explain that, dude, it's a room in there. I go in there just to do business. I come in here to create courses. I come in here to do TikTok. I come in here to do all these things that are part or help my business. It's legit. I don't come in here for any other reason. The only reason I'm in here is I'm working, right? So at the end of the day, it's legit. You just, many people probably aren't taking advantage of that. If you have no other place, no other office, you're working out of your home, then take advantage of it. It's not a lot, but it is something. But you can't just say, I do work on a kitchen table. That wouldn't qualify. Okay. Do not call every worker a subcontractor. Okay, so this is probably the one that I see gets a lot of people in trouble. And I can tell you that there's a gentleman that is up in, I'm not going to tell you where he's at, but he does a lot of basements. For years was simply saying that I pay all these guys and they do that, but he was the one telling them what to do, where to install it, how to install it. They were not independent contractors. They worked for him. So your taxes are due, payroll taxes are due, tracking, all this kind of stuff is due. Very important to understand the term independent contractor. And whether or not you're going to be issuing somebody a 1099 or not. Okay, so independent contractors, be careful. I'm not your tax guy. I'm not your lawyer. I'm just saying there are rules when it comes to classifying somebody as an independent contractor, because when you do that, that person, basically you give them a project, they do it, turnkey. My brother used to do that. So he would get a job, and he would have these guys that are contractors that work for him as some contractors, and they were independent contractors because they would everything, right? Everything would be there. All he would say to them is just wire this house and let me know when it's done. He didn't tell them where to put this, where to put that. The owners had their drawings and their blueprints and all that kind of stuff. He just let them go. Whereas there's other people that hire people, they go out there and they say, I want you to put this here. I want you to put this there. I want you to put this here. I'm going to, I need you, I'm going to run and get you supplies. I'm going to tell you, and this is what you're going to use. You're going to use this brand or whatever. That is not an independent contractor. I'm not a lawyer. I'm not a tax guy. I'm not a CPA, but ask them, what is the threshold for independent contractor? And you're going to see that if you have involvement in it, then that's not an independent contractor. They're not working independently of you. Okay? You have something you're saying in it, and that can get you in a lot of trouble, especially if you're not paying taxes on it, because they could classify those as employees and not independent contractors. You with me? Okay, I kind of got sidetracked. Let's get back to this one. Do not call every worker a subcontractor. Now, whether someone is an employee or an independent contractor really depends on the actual working relationship, not merely what the agreement calls them. Okay, so now if the company controls what the worker does and how the work is performed, the individual may be an employee even when paid hourly, part-time, or even without benefits. The misclassification can lead to unpaid payroll taxes, penalties, and interest. So, folks, again, just because you want to lump somebody as an independent contractor, okay? I know a guy who did a bunch of work for somebody, got paid over $100,000 under the table. And then the guy at the end of the year tried to say, oh, you were an independent contractor. You didn't pay your taxes because that was your responsibility because you're an independent contractor. But the fact is, the guy rode with them every day to the job site, went to pick up things for the job site at the direction of the owner, was there every day, did what the owner told him to do, did everything. That is not the definition of an independent contractor. An independent contractor would say, hey, I need you to dig this ditch. There's a ditch that needs to be digged over here. I don't care how you do it, whatever. I just need it done. I'll pay you to do it. You're an independent contractor. You go get it when you got, fit it into your schedule. And they go do it, and then they send you a bill. That's an independent contractor. I had no say. I didn't provide the equipment. I didn't do anything. I just told you I needed it done. Okay, that's oversimplifying it. But again, be careful. This is the one that I think I see out there that so many people think that that's a benefit to reduce their taxes. Like, oh, I won't have to pay payroll taxes. I won't have to match it and all this stuff. I'll just get these people and do them as an independent contractor. That's fine if that's what they really are, right? Now, let's look at this. For payments made after December 31st, 2025, the General Form 1099 NEC reported thresholds increased from $600 to $2,000 for qualifying non-employee service payments. Contractors should still obtain a completed W-9 before paying any subcontractor, okay? Any subcontractor. Now, again, a subcontractor is a little different than an independent contractor because a subcontractor is somebody that you have no say in it. That would be me building a home and me just paying an electrical contractor to do the electrical. All I'm doing is paying you to do it. I'm subcontracting it to you. But if I'm out there and I'm telling you how to do it as a business and what to do, that's different than an owner saying, I want a receptacle here, I want a receptacle there. That's the owner. That's based on what it's agreed from them. I'm just agreeing to pay them a price to do it and be done with it. They buy the material, they buy everything, they install it, do everything. I have no say in it, that part of it. Anything other than that, you start blurring the lines. And again, that's for you to discuss with your tax person, not me. I'm just saying I see that, whereas everybody wants to lump their work as independent contractors simply because they're trying to get away from paying taxes, payroll taxes and things like that. Also, I want to tell you this, you're not doing anybody any justice by paying them under the table. I get it. It happens. I understand. But they're not paying into Social Security. They're not setting the established rate that they're going to get when they retire. So you can kick that can down the road all you want. Eventually you get down and they get to the point of retirement and there's literally nothing in there. They have no retirement. So you may have thought it was a good idea now, or they did, because they're getting more money in their pocket right now and they're not paying taxes and you're trying to beat the IRS. Problem is they're the ones that get hurt in the end, and you can get hurt if that person realizes that they can't make any money, if they're not making any money, and all of a sudden they become disgruntled. All they got to do is whistle blow to the IRS and say that, you know what, this guy was paying me under the table for this many years and he never took out payroll, and I'm not an independent contractor. I did everything that he told me to do. Dude, now you got big problems. So again, at the end of the day, everybody loves you until they don't love you. You get what I'm saying? Everybody's your friend. Everybody's, oh man, I'm here to help you out, until something happens and they find hardship. They will throw you under the bus every day of the week. So again, just be careful, folks. That's all I'm saying. Don't try to classify something as something it's not just because you think it might benefit you now, because it ultimately will hurt you in the long run. Okay. Tax planning must happen throughout the year, not just at the end of the year. When I started in my business, I just threw stuff in a box and said, I'll take care of it at the end of the year. Do not wait until tax returns is being prepared to discover that money is needed for taxes has already been spent, and you have nothing. Okay, sole proprietorships, partners, S corporations, shareholders may need to make estimated payments during the year. Estimated payments may cover both income tax and self-employment tax. The general self-employment tax rate is 15.3%, subject to applicable wage bases and, of course, additional Medicare tax rules. So an S corporation, for example, owners must also remember that shareholders who works in the business generally must receive reasonable compensation before taking non-wage distributions. Now, for me, for example, in my company, I get payroll. And the payroll is not a big amount. And the reason it's not a big amount is because most of my stuff today is pretty automated. You purchase my courses online. Years ago, I decided not to teach the live courses anymore. All this stuff was strategic in my business. My trade hog is 100% online. My hands are off, but we may have to modify stuff, update the codes, change things. So collectively, I probably spend in the business 15 hours a month, maybe 20 hours and I'm real busy. But it's because I'm so, and I am kind of, when I'm in creating courses, I'm spending more time in it than I am once the ball is rolling and I've already created the courses. It kind of runs itself a little bit. That's not the same as you as a contractor. Totally different. Okay. So my payroll from the company, and we also have to remember I have another salary coming in from other companies that I own that I do pay taxes on that. So I don't need so much to come from the academy to sustain me. So for what I do as an overseer of the company in creating content, I keep track of my time. And people say, well, that doesn't sound like a lot of time. Because I appear to be doing everything and my hands are in everything, but I blot my time. I have a calendar. I make sure that I'm going to do 2 hours of this, 1 hour of this, 2 hours of this, and I'm very focused when I'm working on it, and I stop when I'm done. So I am very regimented. And so this is how I get so much stuff done. One is because I don't have to edit it. I don't have to retake it. Every podcast you hear is not edited. It's straight out of my mouth. Okay, which, maybe I put my foot in my mouth once or twice, but I mean, the end of the day, this is how I am able to keep track of my time, okay, because I'm very efficient. But I don't pay myself a crazy compensation because I don't need to, because the role doesn't need that type of thing, okay? Now, but your business is different because if you're in contracting, you're in it every single day. You're putting in it. So you have to have, if you're an S corporation, you have to have reasonable compensation. What's reasonable? Well, that's something you have to decide. I determine what's reasonable for me in a certain salary that covers the time that I put into the business. I might put in more certain times when I'm creating courses than I do other times. Okay. Now, year-round planning should also consider retirement plan contributions, self-employment, health insurance deductions, and available small employer retirement plan credits. Eligible employers may qualify for a retirement plan starting credit up to $5,000 annually for 3 years. So you may not be able to offer these things in your business. You're early, you're starting out. You can't offer these kind of benefits, retirements, and things like that. I understand. But the moment that you can and you get to that point, you need to start thinking about that. Now, I ran my business for years. I did not have health insurance when I started out years ago. And, I had a young child and my wife, and we had all these businesses, and I just couldn't afford it. It was feast or famine. I was just going to try to stay above water. And that's how a lot of businesses start. Just keeping your head above water and making your way as you can. Then we went through temporary layoffs. There were good times, but, easy cradle ripoffs. But there were good times, but at the end of the day, we made it. And I got insurance for my family as quick as I could. And then I grew from there. Luckily for me, I have a great retirement plan from the other company I work for, Prismium, that have put quite a bit in my 401k. That's a whole nother story because I'm going to owe those taxes when I get there, but it is what it is. Okay. It's still great to have it. Right. So anyway, let's kind of end this podcast on that. I'll give you some things to talk about with your CPA, your tax guy, maybe the guy online, the real tax guy. Talk to him. The goal is not to manufacture deductions or spend money unnecessarily. The goal is to capture every legitimate expense you have, maintain records that can support those expenses, and operate the business in a way that keeps more of the profits that you've actually earned because you're using the system properly. And you're also reducing your risk by tracking everything and taking that extra time. Whereas you may think this is boring to do this as a business, it is all necessary that you keep track of everything. Does that make sense? So for everybody out there that's not in business, that are thinking about getting into business, if you do, start off the proper way, do all these things that I say, and if you have questions, ask somebody that is qualified. I am not your tax guy. I am not your insurance guy. I am not your legal guy. I'm your NEC code guy. I can handle that. But if you need tax advice, then there's people like the real tax guy on TikTok. There's others out there as well. There's CPAs. There's local folks. Check them out. But you know what? Get the answers because you need the answers to run your business properly and not create problems down the road. Make sense? All right, folks, until next time, stay safe. God bless. Again, it's Paul Abernathy with Master the NEC Podcast. Make sure you subscribe. We'll catch you on another upcoming podcast. Take care. God bless.
Thanks for tuning into another electrifying episode of the Master the NEC Podcast. We hope you're feeling more powered up and ready to tackle the electrical world with the knowledge and confidence you need to succeed. Remember, in the electrical trade, knowledge is power, and we're here to make sure you stay plugged into the latest insights, tips, and code updates. If you enjoyed today's episode, don't forget to subscribe, leave us a review, and share the podcast with your fellow electricians and industry pros. Until next time, keep your tools sharp, your circuits clear, and your mind focused, because here at the Master the NEC Podcast, we're all about sparking your success. Stay safe, stay smart, and keep mastering the trade. From all of us here at Electrical Code Academy, thank you for all your support, and we will see you on the next amazing Master the NEC Podcast episode.